Do you like to learn the stock market? Would you like to learn how to build strategies that beat traditional dollar cost average investing? Welcome to Algos with Garen, a show dedicated to teaching you the stock market and how to build auto investing strategies using a software called Composer. In today's episode, we're going to look at a strategy built by Claude Constantine in the Slack community, which has an amazing drawdown of only 13.5%. It has an annualized return of 10%, which isn't as good as the stock market. However, has a 0.5 beta, meaning that it only loses half of the amount of investments that the stock market does, and overall is just a phenomenal strategy for stability and consistency over the long term. And we are actually going to take this strategy and trying to make it better. Hey there, this is Future Garen. It's about 7 p.m., a couple hours into the future. And I just wanted to walk you through what we built in this episode and show you the numbers so that you can expect to know what you're getting in this video. The original strategy was the SPY minimum drawdown, which we see here in the brown, and the purple one is the one that we build in this video. And as you can see, the annualized return of the strategy we're building today is 24% annualized, a max drawdown of 10.9, so a better drawdown than the original, which was 13.5, and a calmer ratio of 2.2. So with that said, I'll let you get back to the video and enjoy watching and learning how this strategy was built. Now this episode is going to be shot a little differently. Typically what I do is I build a strategy and then I go back and I make a video about how I built it. This video, I'm actually going to build this strategy live, and you're going to watch me step by step and then you can see exactly what I do to design my strategy so that you can learn how the stock market works, as well as learn the process of designing a strategy and the do's and don'ts so that you can make better strategies yourself. So if you like this strategy, you like this video, share it, share the symphony, and feel free to iterate or change anything and share your creations on the Slack channel so that we can all profit and learn more. All right, so let's get started. So the strategy here, the S&P 5 minimum drawdown, has 5 pieces. And typically what I like to do is first segment off pieces of the strategy to test individually and isolate each size so that I can figure out like what exactly is going on, and then we can improve from there. So what I'm going to do is just open up a few more tabs of Composer, and we are going to copy these links. Okay, so I went ahead and split up all of the symphony, or all of the sections of the symphony, and we are going to take a look at each one off and on. So the first one is this new symphony. Actually, we've got errors. Let me fast forward. We'll have to back test only to 2013 because it looks like one of the things in the strategy isn't running to there. So this first one, new symphony, we have got outsized returns compared to the S&P 500. We're not going to get into the details yet, but it looks like it's got a higher drawdown, a lower beta, but overall it's still heavily correlated. The next thing we're looking at is the S&P 500, and this is this VOO. It's literally a 1-to-1 of the stock market, so there's nothing fancy here. Then we have Buy the Dip NASDAQ, which we've already covered in episode 1. I've also built multiple iterations of this, and I've got a really phenomenal style, another version of this strategy that we're going to implement into this to improve. Lastly, or the next two we have is Volatility Hedge, and I think this is the first one we're going to start with, and I want to explain something about volatility. So you see this only has a 2% annualization rate and a max drawdown of 7.2. But what's interesting about this is if I take, let's just take the VOO, let's just copy this pillar here, and I bring it over to this strategy, and I paste it in here. So let me drop the threshold down to 3%, and we're just going to do a 50-50 equally weighted, and I'm going to rerun this strategy. And I want to show you something that's very interesting about using bonds in your strategy. So here you can see we have a 50-50 beta. So this means this strategy only loses about 50% of whatever the S&P, it's only 50% correlated to the S&P 500. And as you can see, we've got almost, here's what's interesting though. You see annualized return of 12.8. And you would think with a 50-50 beta, you would not get a 7.7 annualized return. You would get, well, what's 12.6 divided by 2? You would have a 6.3 annualization rate. So why is it that this has a 7.7 annualized return and not a 6.3 annualized percent return? It's almost a 1% extra. And if we go over to max drawdown, we should have a 50-50 on max drawdown. Point divided by 2. Yes. So yeah. So we basically have the exact same drawdown which is equal to the beta of 0.5, but yet our annualized return is 7.7. Now, if you've studied portfolio management, you know where I'm going with this. If you are new to investing, or if you don't quite understand dollar cost averaging or the phenomenon that's happening here, I'll explain it to you in a second. But there's a reason for this, and I want to educate you a little bit on this, because this is a very critical, important lesson for anyone that invests to understand. This is like portfolio management 101. And we're going to watch a video in a minute from, I believe it's MIT professor talking about portfolio management. Before we get to that, let's go back to the strategy. And I want to change around a few numbers. So we're going to change this threshold to, say, 6%. And we're going to pay attention to those numbers and see if it changes anything. So our beta is still 0.5, yet our annualization rate is now up to 8%. And our max drawdown is up 0.15, a little bit higher drawdown, but nothing remarkably crazy. But yet we're making even more annualized return just by changing this threshold. And if I up this to 10%, let's see what it does. 8.5% annualized return and a 15% drawdown. So we've actually reduced drawdown. We're under, and our beta is a little bit higher by just 0.02. So as I increase this threshold, you will see an increase in annualization. And this is an interesting, what's going on here? Okay, so now we've capped out at 8% annualized, and we have a max drawdown of 17.5, which is a little bit higher. So let's do one more thing. We're going to go back to 5%, and I'm going to change this specific weighted, and we're going to do a 20-80 split, assigned remainder. Now we're going to get a higher annualized return, but let's see what the deviation is. So we've got a max drawdown now of 27%, annualized return rate of 11.1, a beta of 0.8 now, so our beta is much higher, and we can see the returns are much closer to the S&P 500. But let's change around this threshold. Let's drop down the threshold to 2%. From a 5, it was 5%, now it's 2%. We've got a 10 annualization, so our annualization rate has gone down. Our max drawdown hasn't changed. Our beta is 0.1, so that's not good. But let's go back and let's up it to 15% and rerun it. So now we have almost a 0.9 beta, almost. Annualization rate a little bit better, and a max drawdown of 30. So it seems like the less we have of UUP and SHI, which these are volatility hedges. These are, we talked about them a little bit in some other videos, but UUP is a kind of an inverse of the stock market, and SHI is short-term treasury bonds, which basically they go sideways the entire time. So if we type in SHI, if you're not familiar with them, they really just go sideways. They don't do anything. I think in 10 years, SHI has only moved 5%, and mostly over this past 2 years. So, yeah, what's going on here? Why is it that just putting bonds into your equity portfolio and trying to hedge against that, you can almost get a 12% return, which is the exact same as the stock market, but you can have a lower beta and a lower drawdown? Why is that? Well, we have to watch this video on portfolio management from MIT to understand this.
So let me give you another simple example. Okay, so let's consider two assets, A and B. In year one, A goes up to basically doubles, and in year two goes down 50%. So where does it end up? So start with 100%, it goes up to 200%, then you go down 50% on the new base. So returns nothing, right? It comes back. So asset B in year one loses 50%, then doubles, up 100% in the year two. So asset B, it basically goes down to 50% and it goes back up to 100%. So that's when you look at them independently. But what if you had a 50-50 weight of the two assets? So someone is quick on math.
Okay, so just to explain real quick, he's not talking about two assets in a portfolio. He's just saying if both assets do that, your net return in 2 years is zero. But what happens if you combine them and rebalance? So what he's going to do is rebalance the strategy. And for you, so you know, when I was changing around these threshold numbers, this is what I was doing, and this rebalancing effect will change the returns over a long period of time. So let's watch this next part.
Math can tell me what does it change. So A goes up like that, B goes down like that. Now you have a 50-50, A and B. So let's look at magic. So in year one, A, you have only 50%. So it goes up 100%. So that's up 50% on the total basis. B, you also weight 50%, but it goes down 50%. So you have lost 25%. So at the end of the year one, you actually, so this is the combined 50-50 portfolio, year one and year two. So you started with 100. You're up to 1.25 at this point. Okay. So at the end of year one, you rebalance, right? So you have to come back to 50-50. So what do? So this becomes 75, right? So you no longer have the 50-50 weight equal. So you have to sell A to come back to 50 and use the money to buy.
Okay, hope I got it sped up, so hopefully that made sense for you guys. You have 50% of your portfolio, and so the first asset, A, did 100%, but you're only getting 50% of that exposure, so you're only getting 50% of that 100, so you get a 50% return on A. But then B, you also have 50% of that, but you're getting 50% of that minus 50, which is 25%. So 50%. So asset A is a 50% return. Asset B is a negative 25% return with a total return of 25% or 0.25. So year one, you're actually up 25%.
B. So you have a new 50-50% weight asset. Again, you can figure out the math. But what happens in the following year when you have this move? This comes back 50%. This goes up 100%. You return another 25% positively, without the volatility. So
yeah. So let's do the math on that then. Year two, asset A, after math, you only get a negative 25% return. So asset B, you get a 50% return after math, totaling another 25% return. So you're net up 50% at the end of year two when you use a balancing method.
You have a straight line. You can keep. So this 2 year so that's so-called diversification benefit. And
okay, so this is why diversification is important in portfolio management. People that don't study the mathematics of portfolio management, the average person, they understand that they need diversification to mitigate risk, but they don't necessarily understand this mechanism of risk diversification. There's actually a company that famously markets to this exact strategy. Let me show them to you real quick. You may have heard of this company called M1 Finance. They're extremely popular, and I actually used to use them quite a bit because I like them because their marketing strategy is essentially rebalancing. So they essentially have these pies, and they say you can set the percentages of whatever you want your asset allocations to be, and then they will auto balance for you. And the idea is they're taking this concept and they're just marketing it and creating it as a staple point in their strategies. And for the composer developers that are watching this, I highly recommend that you copy something like this in some kind of like mass macro rebalancing for portfolios. I personally would love to see in my portfolio itself an ability to rebalance all symphonies at a 5% threshold or a 10% threshold. I think that would be amazing. And so I wouldn't have to do it manually because I'm going to do it manually and that's going to suck. So please copy M1 Finance on rebalancing out your total symphonies in a portfolio. But long story short, what you need to know, when you correlate two assets like bonds and stocks, which bonds are flat completely all the time, you can drastically reduce the beta or the drawdown of your strategy while still increasing an outsized return amount. Now, that's for a simple traditional dollar cost averaging strategy. People have been buying stocks and bonds and balancing portfolios for the past 80 years or so, and it's a very old school way to do it. But with Composer and automated investment machines, we can take this concept and design something that does it even better. So let's do that. Okay, so we're gonna go back to our strategy, and I'm gonna let's drop the balancing threshold to 10%, and we are going to go back to a 50-50 weight. Just to make it simple, we're gonna rerun this. I think it was like a 0.5 beta and a 8% return or something. Yeah, 8.5% annualized return, extremely low drawdown, so better drawdown than 50 beta. Our beta is 0.52, and we're gonna start just messing with stuff. First, I'm gonna delete shy, and I'm just gonna do UUP and see how this performs. So we've actually done worse, so I'm gonna undo that, and I'm gonna delete UUP, and I'm gonna see how this does. That also doesn't perform well, so I'm gonna undo that. And we're going to add an extra one in. We're going to do TLT, which is 20-year bonds, and see if this creates any kind of difference. And it looks like that doesn't do well at all either. So here's the part where I'm going to tell you, a lot of my backtesting and strategies is just sitting here for hours and just throwing things in and seeing what sticks and what doesn't. And this can take a lot of time. So I'm going to pause the video and do this a bunch and see what I can come up with, because it might take me an hour, and I know you don't want to sit here and watch me click buttons for an hour, and then I'll show you the results. Okay, after about like 30 minutes of just testing things and throwing it at the wall, I think I got something that's actually really nice. Okay, so this is the strategy now, and let me run you through the numbers real quick. I went ahead and made another, when I backtest, I like to like anchor. I went ahead and saved the default one to Volatility Hedge, S&P 500, 10%. I saved this as a SPY bond test, and then I loaded SPY bond test on here so you can see it out performing against the one that we're building. So this one that we built, the new one, has 148% cumulative returns, and the numbers, we went from an 8.5 annualized to a 9.3 annualized. Our max drawdown is 7.9%, so we're almost half the drawdown of the original one, and we are like like a quarter of the S&P 500's drawdown. Let me do the number on that real quick. Yeah, we're less than 25% of the max drawdown on the S&P 500. We've got a beta of 0.34, which is just crazy good. I'm very happy with this. This could be a strategy in itself alone. You could do very minimal modifications to this strategy, and it would be almost as good as the S&P 500. Let's change around the threshold real quick, or actually, let's change around the weighting and see what this does. So we're going to switch this to a specific weighting, 20-80%, and we're going to rerun this and see what it does to the S&P 500. Yeah, it does pretty well. Annualized return of 11%, max drawdown of 24%, so the drawdown's gone up more, but that's understandable. Let's reduce the, I can't remember, I think we did better with a lower threshold. There we go, 5% threshold, see what that does. Yeah, we're almost up to par with the S&P 500. We got a 0.73 beta and a 23 drawdown. But okay, let's go back to the equal, and we'll run that. Let's do a 8%. See if we can get a little bit better numbers. 9.5 and an 8%. Drawdown's up a little bit more, but the annualized return is a little bit higher. So I think we'll leave it at there. And if you, I'm going to go ahead and remove the S&P 500 pillar, and we're just going to go back to the volatility hedge. And if you remember right, when we first ran this volatility hedge, I think the annualized return was like 2% or something. We've doubled the annualized return to 4%. And I know that doesn't sound like anything crazy, but that's a lot when we're literally just switching between bonds and UUP and a little bit of VIXM, which is a volatility hedge. But let me go ahead and walk you through the strategy so you understand it. So the volatility hedge, the first thing it looks at is the 5-day cumulative return of UVXY is greater than negative 0.5. So UVXY, I use this a lot in my strategies. UVXY is a volatility hedge, and this window down here is rolling returns of 5 days. So I'm going to switch this to 5 days, and as you can see, anytime UVXY crosses above negative 0.5, which is right whenever we cross above the dotted line, we are negative 0.5. We are going on to this next part of the strategy. So when cumulative returns of 5 days are above the dotted line, we are going to run this inverse volatility of 5 days, and we're sorting between VIXM, UUP, and UVXY. And inverse volatility essentially it weights each asset based on the volatility of the asset, which is an interesting way to do that. Now, if UVXY is not greater than 0.5, then we are doing another inverse 5-day volatility of UUP and SHY. So in this strategy, we've got VIXM, UUP, and UVXY, and this one we've got UUP and SHY. And actually, I'm going to delete UUP real quick just to see what that does. No, that looks... Actually, that's better. Spy pillar. What's going on here? Why new symphony? What'd I do? I did something wrong. Let's rerun this. There we go. But if I delete UUP and rerun this, that's odd. That's very... I guess it counterbalances it. Okay, so going back to UUP, that's weird that it does a complete shift on that. But if we go down to the holdings, we can probably find days that this procs. So you can see we've got it procs on certain days, but we only have a weight of UVXY of like 1% and 5% on VIXM, and then the remainder is in UUP. And these tiny little percentages of the inverse volatility basically are hedging. They're doing the portfolio rebalancing effect. There's a thing you should know when it comes to portfolio rebalancing. Typical traditional portfolio rebalancing is done with bonds, because bonds are just seen as kind of like a stable. It's almost no difference than rolling it into cash and just holding it as cash, because bonds don't really return a lot. They used to way back in the 70s and 50s. They actually had pretty good returns, but today they're just kind of like flatlined. So a better thing to do is you instead of using bonds, you want to use inverse uncorrelated alpha assets. So the S&P 500 is inverse to VIXM and UVXY and UUP. So we are basically rotating the money from S&P 500 into the hedges, and then we're making the outsized return. So if you look at the two assets that we just designed, if we go back to this board here, our A asset of 50% is S&P 500. Our B asset is this volatility hedge that we just built. And as I showed you, that volatility hedge has like an annualized return of like 4 or 5%, which isn't a lot. But when you combine two assets, the A asset and the A asset is the S&P 500, which is, I think, returns 12%. And then the B asset returns 4%. When you use them in conjunction to rebalance on each other, you get that portfolio rebalancing effect where you get an outsized return with very low beta, very low drawdown. So this is like the core tenet of portfolio management. I hope this is like the most important thing you can possibly learn. I recommend if this isn't making sense to you, or if you're new to this, take some time, watch this MIT video, watch portfolio management videos, understand the importance of rebalancing and diversification, because it's not just like, oh, you got to mitigate risk by having a lot of stocks. No, there's a rebalancing effect that has to occur for you to get really good returns on this stuff. Okay, so I really like this strategy. I'm going to save this as its own, like, I'm not going to invest individually into this strategy, but I'm going to use this volatility hedge because I like this. I really like this strategy. We'll just call it Garen's Advanced Volatility Hedge. And I'll have this on the Miro board. If you guys haven't seen, I know I pull up my Miro board a lot. Guys. And if you can see this in the video description. If you click on the YouTube video description, there's a link to this Miro board so that you guys can go through this. I'm going to copy and share this volatility hedge if you guys want to use it in any of your strategies, and I will post it into the new board here. And you also have links to all of the strategies that I talk about in all of these videos. So the last video, how to make 1.4 billion in 8 years, these strategies are posted in here so that you can use them if you need to. So I'll put this volatility hedge in here for the next one. But we're going to go ahead and take this, copy it, and we're going to go back to our original Symphony. Okay, so we're going to take note of the numbers. Annualized return of 11.4%, max drawdown of 13.5, and a beta of 0.5. So we're going to delete this one, and we are going to add the volatility hedge advanced. Oh, and we need to change the rebalancing because our rebalancing on the volatility hedge was 8%. Let's test some different ones. We'll do 5% first. Okay, so our max drawdown dropped by 0.5. Our annualized went up a little bit, but our beta dropped by 0.05. So that's a pretty good drop in beta. And we're only weighted 20% on this volatility hedge. Let's move the threshold to 8% and see what it does. 8% is what we tested the volatility hedge at. 11.3, max drawdown still, beta. So we get a little bit more annualized return. But yeah, it's looking pretty good. So you can keep messing with that, and you can keep finagling numbers or increase. We could increase this weight to 30%, and then maybe. Well, before we do that, let's start messing with some other stuff. So let's go to the oil hedge. So the oil hedge, max drawdown of 52%. That's not too great. Annualized return of 0.7. So it doesn't have that great of an annualized return, but it does have this increased performance here in this area. And this is because of COVID and increasing inflation as commodities and oil prices rise when inflation rises. So this oil hedge looks to be a hedge against inflation, and we're investing in DBO. So immediately, the first thing I can see that we can improve is we have this bond hedge here. So I'm just going to delete the bond hedge, and I'm going to add in the advanced volatility hedge. So we're going to go back over to the advanced volatility hedge. I'm going to copy this and paste it back into this oil hedge, and we're going to see what the returns are now. And it seems to increase the annualized return just a little bit. Drawdown's like 2% less. It's nothing crazy, but I'm going to mess with this a little bit more and see if I can get it to do better. So I'm going to start messing with this DBO bullish and bearish, and I think I might try to do like a mean reversion strategy here. Okay, after messing with it a little bit, I really didn't have to change a whole lot on this one. I just added a weighted equal, and I added in EIO. I could mess with this and make it even better and tweak it and stuff, but it looks like we've got better outsized returns on the back end here while the market's kind of coming down. And this makes sense as commodities have been increasing because of inflation. And I could build like a mean reversion or something here. There's definitely a lot of room for improvement. So if anybody wants to take this and run with it, they can, but I'm just going to leave it as is for now. So we're going to take this oil and bond hedge, and we're going to copy it, and we're going to go back to the original strategy. We'll look at the numbers again. Max drawdown of 13, annualized 11.3, beta 0.45. And we're going to delete the old one, and we're going to add in our new one, oil bond hedge. We'll just call this Garen mod V1, and we will run it back. Look at that, max drawdown of 10.9 now, annualized return better than the stock market, and a beta dropped by 0.1. So we are getting close. We're starting to beat the stock market. So that is the oil and bond hedge modified. Now, I'm just going to delete this pillar right here, because this pillar is just the stock market, and I don't think we really need it. I'm going to add that weight into evenly. I'm going to do 5% on the risk SPY risk on, and then another 5% on the NASDAQ by the dip. And we're going to rerun it, see what this does. Max drawdown went up a little bit. Annualized returns went up a little bit. Beta dropped though. So our beta, that makes sense because we removed a portion of the stock market. So we're less correlated to the stock market. So that's went down. So overall, I like those numbers. Let's go ahead. I've already tackled NASDAQ by the dip. We'll change this last. The next thing we're going to look at is this section, the risk on, risk off. Okay, so looking at this strategy, we'll take a look at the risk on portion. And it looks like we've got a simple weighted function of 83% stock market, 16% bonds, and we're doing a rebalancing. Like, this is designed for a rebalancing effect like we've been talking about. And we're doing a 10-day max drawdown of the SPY is less than 5%. So we're looking at the past 10 days. If the drawdown is between 5%, we're essentially risk on. And if we're below that, meaning the stock market's dropping in a 10-day period, we are going to go risk off. But just running the back test, let's look at the numbers real quick. We are doing an outsized return already of this. So max drawdown of 40%, annualized return of 17%. And this strategy alone is it's a good strategy. Let me take a look at this real quick. Yeah, just to make sure we got it off. So I'm thinking what I'm going to do with this portion is I'm going to experiment with some inverse volatility switching, like what we just did with the volatility hedge, as well as mess with the risk off strategy first. Let's do the risk. Let's handle the risk off first in the this section. So I'm going to start messing with stuff, and again, I'm not going to record me just hitting a bunch of buttons because it's boring. But I'll show you what I end up building. But just know whenever I'm pausing the video, all I'm doing is literally just like testing stuff. Like it's just boring, tedious work where I'm just changing out things and changing out ETFs, and I'm just trying new things and just seeing what works and what doesn't. Okay, let me show you what I did. We got the max drawdown a little bit. The annualized return is a little less, but the beta is 0.6 now. We had a mastic reduction, a 0.25 reduction in beta. And what I did is I switched out that risk off for this function is actually copied and pasted from the previous video, how to make $1.4 billion in 8 years. The TQQQ for the long term made by Derek Nicholson from Reddit. I went ahead and copied the short function that he has in here, which is this one. It's current TTQ. It's a 20-day move average of TTQ. Do this. I went ahead and copied that and modified it for the S&P 500. So we're looking, if the stock market is doing 5% or less, we're risk off, then we are switching to this function. And this thing looks at the 20-day move average of the SPY. So if we go to the SPY, go to the daily chart, we are looking specifically at this white line here. Let me turn off my EMAs. So just this white line. And if we're below the white line, then we are running this relative strength index right here, where we're switching between bonds and SH. SH is a short version of the S&P 500. So the S&P 500 is like this. SH is the opposite. It's the reverse of that. So it's a short function. And if the 10-day max drawdown is less than 5, but we are above the 20-day, then we run this function, which is looking at the 10-day RSI of SH. If it's less than 31, we take this is essentially a mean reversion, so we're taking a short position on that. What I can do is I can actually add PSQ in here, which is a different version of short, and just see if it changes the function at all, or the returns at all. I think this is a 2x instead of a 1x. So no, that's actually worse. We've dropped the annualized return, so we don't want to do that. And I'm also going to switch the threshold to 8% because that's what we had it set at for the main strategy, just to see if that does anything different. Beta's a little less, but that's it. So I'm going to keep messing with this and see if I can improve it more. Okay, so what I did is a few things. One, on the risk off side, I added the advanced volatility hedge here, and essentially we're doing a 50-50 split on the short function I had here that I copied and pasted. So we've got a short function here and a volatility hedge on the risk off side of the strategy. And as we can see, I went ahead and made the original version. I copied and pasted it here and saved it. It's called the S&P risk on, risk off. And you can see the original one is this gray line, and the current one we're editing is this green line. And we're starting to get outsized and better performance on this back end here during this bear market. So currently, we've dropped the max drawdown to 32%. Originally, it was 40%. The annualized return is up 20% from 16%, and our beta is 0.88, whereas I believe beta's up a little bit, but other than that, it's good. I'm going to try to continue to mess with this section here where we're in this bear market side of the strategy and see if I can get this to smooth out a little bit. Okay, I got it pretty good. I went ahead and deleted the advanced volatility hedge, and I moved it into this function here. So when the S&P 500 is below its 20-day move average, which is again the white line here, we run the volatility hedge as well as this relative strength index short. So we're doing a short position plus the volatility hedge, and it seems like if I just paste this volatility hedge everywhere in my strategies, it makes it better. So this this advanced volatility hedge is really good for S&P 500 strategies. Anytime you're trying to hedge, anytime you're trying to go risk off, it seems that it works exceptionally well at that. And I also pasted it inside of the risk on side of the strategy. Let's walk through this section of the strategy real quick. So the first thing we're looking at is the 10-day max drawdown of the S&P 500 is 5% or less. And I believe I have a indicator where I can add onto the charts for you guys to see this. Let me see if I can find it real quick. I believe it's drawdown over window. I think it's this one. Yeah, there we go. So if we change this input to 10-day, you'll see, and then I add a line here on, let's go to SPY. When the drawdown is more than 5%, we go risk off. So right here, so these sections here, we're going risk off on a 10-day period. Down here as well, so it triggers during the COVID collapse, and it also triggers here. We go risk off, and we switch to this next function, which is a 4-day max drawdown of the S&P 500 is equal to or less than 3. So the original version was this right here. So we just had a split 83%, 16% SSO and TFM, which is 20-year treasury bonds. And I went ahead and just made it flat SSO. So it's 100% SSO, and we're essentially full risk on. And SSO, for those that don't know, is a 2x bull position on the S&P 500. So we're actually 2 times leveraged into S&P 500, and as long as we are above 3% drawdown for a 4-day period, we are risk on, and we are going to run full 2x leveraged on S&P 500. Now, if we dip below that and we are still in between a 5-day drawdown, pretty much everything in this area above this line, we are risk on. And then everything below that line, we switch to the risk off. And then we have a secondary risk off, which goes to the sort function on RSI. We select the bottom RSI between SSO, which is, or TFM. So we're just kind of rotating back and forth to whichever one has the better RSI. And we also have the volatility hedge. And that's what we're running right now. And I'm going to test one more thing. I'm just going to delete that and run it back with the volatility hedge and see if it actually performs better. No, doesn't seem to really change a whole lot. But okay, so that's pretty good. I think I'll leave it at that. There's definitely room for improvement on this. I could do some kind of mean reversion, but I don't want to spend the time to do it, honestly. So we're going to take this and call it S&P 500 Garen mod V1. We'll just save that. And then we're going to go back to our strategy, and we're going to add this in here, and looks like go back to 35%. So yeah, 35. We're going to run it back, and we should get even better returns now. I should have looked at the numbers before I did that. And we are beating the S&P 500 now. So max drawdown of 9.9%, annualized return of 14.8%, beta of 0.41. We are doing really well. I'm liking the way this is coming together. And then finally, the NASDAQ by the dip. You know what I'm going to do. We don't even have to mess with this. I'm going to go find the one that I edited. Okay, so here we go. We got better by the dip by NASDAQ. I already made videos on this thing. It was in the previous video. It's in this video. And it's got the better QQQ in here as well, which is a better assortment of QQQ companies. Just to show you this strategy and like what its returns are to 2012. It is pretty good. Max drawdown, standard deviation. I wonder if I could add my risk off strategy to it. I bet I could probably make this even better with that volatility hedge strategy, but I don't want to right now. We'll leave it as is, and we're gonna go back to the main strategy. We're gonna delete the NASDAQ by the dip, and we're gonna do a better QQQ. A better NASDAQ by the dip. And we're going to assign the remaining, drop it down there, and let's see what we got now. And look at that thing. Max drawdown of 12.7. So we're better drawdown than the original strategy. We have an annualized return of 29%, a beta of 0.46, alpha of 2.1. I really like this strategy. I'm very proud of this strategy. I'm going to pause the video real quick. I'm just going to finagle some weight numbers and threshold numbers and see if I can get this a little bit better. Okay, I went ahead and switched around the weights a little bit. I think I took a little bit off the S&P risk off, 1% or 6% off of the buy the dip, 2% off the volatility, and I increased the oil hedge quite a bit, and I found that by increasing the oil hedge, it drastically reduced the max drawdown and beta, which makes sense because it's going to perform better and heavier in this area where inflation is high. If you watched the first episode, Beating the S&P 500, we talked about the super cycle of commodities and stocks and how inflationary periods like the 1970s and currently now, typically commodities perform better and do better because of rising cost of resources. So it makes sense that the oil hedge would be making this thing perform better during this period. The buy the dip NASDAQ strategy has a lot of mean reversion to capture profits on the collapse of the COVID. So that's where we see that big run up on profit here. So this section right here, the buy the dip NASDAQ is really profiting, as well as the volatility hedges that we put in place also kind of mitigate that. And then we're profitable in this current period, mostly because of the oil hedge and also the dip buying strategies of the other ones. And if we remove COVID and we go back here, it's not really anything crazy, but I think this strategy excels when we hit market crashes as well as when we're doing a super cycle switch from commodities to equities. So yeah, I'm very happy with this strategy. I'm very proud of it. And shout out again to Claude for building this thing and building the backbone. I'm going to continue to mess with this and use this as a strategy, but there's plenty of room for improvement for this strategy. If you guys want to mess with this and start going into the things and tweaking the things, I know there's a lot of room for improvement for mean reversion. So there can be places added for mean reversion and buying RSI dips and stuff on the strategies, especially for the S&P 500. But the main thing that I want you to take away from this video is the lesson of portfolio management and rebalancing. It's an extremely important thing to understand when it comes to building strategies and your overall success years into the future. And back to the composer developers, I would love to see a function inside of our portfolios where we can rebalance all of our symphonies at a certain threshold. Say, personally, I would like to see once a strategy becomes more than like 3% or 5% of my portfolio, profit-wise, I would like to see it rebalanced and redistributed into the other symphonies, because there's no guarantee that all of the symphonies are going to run efficiently throughout the next 20 years. And I'll leave a link below for the YouTube video for you guys to watch the MIT professor lecture. I know that might sound boring and tedious. Trust me, it's one of the best videos you'll probably watch on this stuff. And I'll leave a link to the Miro board, as well as inside the Miro board, there will be links to all of the individual strategies we built in this video. And yeah, I think that's it. So I hope you guys enjoyed this video. Again, like, subscribe, share the video. That helps me out tremendously with growing this channel because we're a small channel right now. And if you have any questions, hit me up.